Blog Talk Radio.
Good morning from sunny Orange County, California. I'm Brian Dooley, CPA with Tax Talk. And today we're talking about tax savings for the small business owner and the real estate investor using a combination of the new IRS home office rules, which are really taxpayer friendly, and taking that rule and leveraging it to change some interest expenses that may be personal, non-deductible expenses to business expenses. And to some degree, our home interest expense was a pretty good deal for most of us. For some of us, it's not reducing our self-employment tax, which is a gross tax of 14%. So it'd be nice if we could allocate it over to that. And as most of you know, I am a fan of the virtual world that is invisible. And my assistant is Rob the robot. And Rob, how are you today?
Brian, I am feeling fine. Thank you.
Great. And we just have a lot of exciting stuff. Rob's done a lot of research. He will help me a lot with this. So the home office deduction, it always seemed to me as a small dollar amount. I say this because we're deducting a home loan interest expense and property taxes. So what we've picked up in the past is, a little bit of depreciation on the home, but that's over 40 years, so that's not a huge deal. It's just a fraction of the home. A fraction of maybe of guardian expense or homeowners association dues. And a lot of CPAs, including myself, did not like to have clients place this on their return because it was such a hot-button item with the IRS, it greatly increased the chance of a tax audit. But now, this new rule is an IRS safe haven rule. And it is so simple. This is the rule. You take the amount of square feet that you use for your home office times $5, and that is your deduction per year. You're just going to use the simplified form. You're going to check the box on the home office expense. But once you establish a home office expense, then what happens is your automobile expense is almost fully deductible. And this is how this works. When an employee drives to work, and that includes if you have your own business, if you're self-employed, that commuting expense is not deductible. When you drive home, it's not deductible. Or if you were maybe like a CPA to go out to the client's place in the morning, maybe it's a 90-mile drive, which happens a lot in California, that's still a commuting expense. It's not deductible. So with the home office expense, what happens now is you will have two offices, your real office with a building and staff and receptionist, and another office, which is your home office. If you work in your home in the morning before you leave, then they travel from your home to your first place of business, your clients or your office, is deductible. So, for example, in the morning, I get up pretty early. I'm up by 6, working away, getting a head start on my emails. I work here for about an hour and a half. If I have to call somebody in the UK, as most of you know, I do cross-border taxation work. I make my phone calls because their time is 3 or 4 in the afternoon. And then I get myself dressed and I go off to work. I have already worked in my home office. When I drive to my office, that is a tax-deductible trip. Round trip for me to my office and back is about 60 miles. For California, that's not uncommon, unfortunately. And it adds up. It adds up. You do that 5-6 times a week, there's a big deduction. But there's more to that. Once you establish that you have a home office, the next thought process, and you could do this next thought process without the home office, is to look at how you are financing your business. Now, a lot of people have very viable businesses from their home. They make millions of dollars. My wife loves the Housewives of New York, and Bethany was one of my favorite housewives to watch because she was a businesswoman, and you may not know about her, but she started a liquor manufacturing business which she sold for $100 million. It's about 2.5 years old, and she ran the whole business from her home office. She had a couple of staff who came in. She outsourced a lot of her marketing, manufacturing. She was manufacturing a low-calorie margarita. And the outsourcing and working in teams with the cloud is becoming more and more common. So a lot of people are working from a home office. They're skipping the cost of a big computer network, rent, and are making a fortune. And when we have to finance this activity, sometimes banks have a hard time with it, especially if you're a startup business. Going back to the example of Bethany, I imagine, and she never talked about it on the show, but I imagine she could get no bank financing. I mean, she's working out of her home. Who's going to think she's going to make $100 million? And so sometimes we have to use our credit card, and we get interest charges. Sometimes we take an advance on a credit card, and we put the money in our checking account to pay bills that need a check. Sometimes we get a home loan, a line of credit on a home. And so the IRS has some rules from the heydays of small business promotion, which is the time that President Reagan was in office in the late the 1980s. And this law is from 1987. Quite a few accountants, after about 25 years, have forgotten about it. So we're going to go over that too. But first, I want Rob to give me the highlights of the IRS press release on home office.
Oh, yes. This is great. Every business owner can have a home office deduction. Here is what the IRS announced. The new optional deduction is capped at $1,500 per year, based on $5 a square foot for up to 300 square feet. It'll reduce the paperwork and record-keeping burden on small businesses by an estimated 1.6 million hours annually. And Brian, the IRS goes on to say, current restrictions on the home office deduction, such as the requirement that a home office must be used regularly and exclusively for business and the limit tied to the income derived from the particular business, still apply under the new option.
Rob, thank you. I want to focus on that last little statement from the IRS press release because they're still trying to kind of beat us up. So it says that the home office must be used regularly and exclusively for business. So there's been some case laws on the word regularly, some on exclusively, but more the word regularly. What does that mean? So let's talk about exclusively. That's the easier one, because my home office has to be a office that's only used for business. I mean, you could walk through it, you could put a cup of coffee down on it, or maybe take a phone call, but it's really used for business. Well, in today's world of cloud computers, unlike when this law was written last century, people do not really have a home office that often. Some people are just working on the cloud, working on a laptop. And that's myself. I'm working on a laptop at home. There's a couch in our living room where we have a TV, and it has a funny angle to it. Nobody wants to sit there because you can't watch TV. Now, I like it because I'm up in the hills of Silverado Canyon in Orange County, and it's beautiful. So I sit on that couch, put my feet up, my laptop's in my lap, my cell phone's next to me. Hey, I'm in business. That couch is used exclusively for me. Now, my home office deduction, I'll grant you, is pretty small. I mean, maybe the couch is 5 feet long, 2 feet wide. So what? That's 10 square feet times $5, $50 a year. But when I leave my home office and go to my other office, it's all deductible. So a lot of us are going to have to think about this, because you want to be sure if you have an audit, which I doubt now with this new safe haven rule, that you at least have a place that's exclusive. So I suggest if you're like me, you find a chair, and that's your favorite chair, maybe one that you really like, or you get a chair that you like a lot and get yourself really comfy, because you're going to deduct that chair, keep in mind, because that's your office. And it's fully deductible under Section 179 for those of you who like tax law sections. So that is the other part. Regularly, first it started off that you had to meet customers and so forth. But in today's world of web meetings and phone calls and phone conferences, I rarely meet a customer. Matter of fact, most of my customers are not in the state. No customer, I haven't had a customer in my office, I don't know how long, because nobody wants to fight the traffic to come see me. So regularly means that you use it often. In my case, 5-6 days a week, I do my emails from there. That's really regularly. So those are the rules to get this going. Now, there's just a lot of other items about the auto expense. Even if you do not qualify for home office, you still can deduct your auto expense. And those of you who have questions, just send me an email, and I'll get into that more deeply. So let's go on to some of the other things, which is this interest deduction. Now, I had Rob take a look at the tracing rules, and he's going to kind of give me a good explanation, or give us a great explanation.
Yes, I did. Brian, most tax planners do not know these rules. They were written a quarter of a century ago. In 1987, this law allows great tax savings to the individuals that know how to play the game. Here is the general rule. It is a little technical. If debt proceeds are deposited into your bank account which has unborrowed funds, then expenditures are first allocated to the borrowed funds. For example, you have an account with $2,000. You borrow $8,000 with your credit card. You use $5,000 for office supplies and $5,000 for payroll. All of the interest on the $8,000 loan is a business expense. If the proceeds of 2 or more debts are deposited in the account, then the proceeds are treated as expended in the order in which they were deposited.
Very good. So you can see that the rule is pretty precise. And the goal is to try to get your interest expense as a business expense. And here are some tried and true methods that I have used for years. The nickname for this is called the tracing rules. So when you talk to your CPA, you use that term, and that may jog his memory from the 1980s. Now, one of the most popular methods is an easy election to make your interest expense a business expense, which includes rental properties. So in case you had to borrow money for your down payment or to do improvements, you deduct that interest as a rental expense. Now, there's some elections you want to make, and this is where you want to be sure you're working with your CPA. So these are very precise elections. There's a short time limit, 15 days for you to get your act together. And that's why if you're going to be borrowing money, you want to give your CPA a call. And the way this election works is that you can elect to treat any expense made from an account with borrowed funds within 15 days after the debt proceeds were deposited as made from those proceeds. So what happens is your account gets kind of commingled, and maybe you borrowed money, you put it into your checking account, and then you had other cash in the checking account. You have a different loan coming in, and you really want to be sure you're going to allocate the interest expense of one particular borrowing or the money that's in the account to a business activity. So you pay your bills, and any bills you pay from the date you got the loan within 15 days, you can say all those bills go to this debt proceeds so I can deduct the interest. So, in other words, a taxpayer may treat any cash expenditure made within 15 days after receiving the debt proceeds as cash made from the debt. So, it's straightforward, but there is a pre-thought that needs to be done. And this is used when you have a money in account that was yours before the loan and you also borrowed money. So it's a kind of if you do not use this rule, it's a last-in-time rule, and it can really destroy your deduction. The next way to enhance this method is by having more than one bank account. So many of us have a business checking and a personal checking. You want to be sure that you do not take your loan into your personal account. The rules that allocate your expense are called the ordering rules. It's a time order. And you want to be sure that you have it easy to trace for the IRS, because tracing is the whole key here. The ordering rules are a trap for those taxpayers who do not know the ease that it can be avoided. So once again, you really have to stay on top of this if you want this tax benefit. For example, you want to improve your rental property. Maybe you've been depositing your rent checks in your personal account. You want to really stop that. You can deposit in personal account, but you want to have an account where you only put the loan proceeds, maybe a credit card advance, a loan from a family member, or even a loan from one of your related companies, into that account. So that is kind of the neat thing. Now, Rob, you did some research on another loophole that's in the regulations.
Well, an example in the regulations suggests that the 15-day election period may be extended by transferring the debt proceeds from one account to another within such period. Once the debt proceeds are transferred to a new account, the applicable time period begins anew. This presents a planning opportunity if the taxpayer desires to have the proceeds of a specific debt utilized for a specific expenditure and the expenditure is not made within the 15-day time period. The taxpayer can move an amount equal to the debt proceeds into a new account as often as is necessary in order to keep the applicable time period open. Brian, another tried and true method is to simply segregating the debt proceeds in a separate account would achieve the same result more easily and with greater certainty.
Thank you, Rob. And Rob's loophole comes for the business person that is planning on making a big expenditure and something got delayed. The project hasn't been achieved. Maybe the tenant hasn't moved in or moved out. And so you borrowed your money and now you need more time. By transferring it from one business account to one investment account so that you could trace it to another, and then again, you can keep extending this 15-day period of time. So it's really, really useful. Now, I prepared a special Excel worksheet on home office computation because some of you may not want to take this $5 item and want to really take full advantage of the mathematics of allowing a lot of expenses to come in. Those of you who are living in an association with big dues or you actually have a larger home office, this Excel worksheet will compare your different methods to the safe haven and let you make the best choice. Now, Rob, can I have you find that link and put it on our show notes?
Yes. I will put the link on the Blog Talk page for this episode.
Great. Thank you, Rob. Well, this is the end of this episode. Of course, call me if you have questions. I'm Brian Dooley, CPA. My phone number in Orange County, California is 949-939-3414, or just drop me an email. By the way, I'm getting active in Google Plus. In the next few weeks, I will have both text and video chat with what's called the Google Plus Hangout. I'll be available each morning from about, I'm at home from 6 to 7 on my couch. Talk to you all later on. Have a great day.